Welcome to this brief explanation of the income statement, also known as the profit and loss account. This is one of the three main financial statements produced annually by limited companies. The others are the statement of financial position or balance sheet and the cash flow statement. The income statement shows the profit earned by a business over a period of time, usually a year. Here's an example. Basically, it's fairly straightforward. In order to make it more informative, extra detail can be added. If possible, the cost of goods or services which are sold should be shown separately from other expenses. This is known as the cost of sales. Note that this introduces a subtotal called the gross profit. This may be regarded as a measure of the success or performance of the people responsible for buying and selling products or manufacturing and selling products. The remaining expenses can be split between operating expenses for the day-to-day running of the business and interest or finance costs. Once again, there is another subtotal. This time it's the operating profit. As its name suggests, this is a measure of the performance of the people responsible for all the business operations, regardless of how the business is financed. In many cases, you will see the operating expenses analysed into distribution and administrative expenses. You will also find other income for items not included in the gross profit, such as any profit on the sale of a non-current asset, like a building. Having made a profit, the company will probably have to pay tax. This is shown at the bottom of the income statement. Again, there is another subtotal. This time it is the profit before taxation. The profit for the year belongs to the shareholders, and therefore it is one of the company's liabilities. It is added to the shareholders' funds or equity on the statement of financial position, minus any cash which is paid to the shareholders as dividends. What you see here is a typical presentation for the published accounts of a limited company. An income statement for internal use would generally contain more information, in particular a more detailed breakdown of the expenses. An income statement for a sole trader would not show taxation because unincorporated businesses do not pay tax, although their owners do. As with companies, the profit increases the liability to the owner on the statement of financial position, but instead of being called equity, this time it will be called owner's capital. Going back now to the cost of sales that we saw earlier, if a business makes its money by buying and selling products, then the cost of sales is calculated as shown here. If the business manufactures products, then the purchases line is replaced by the cost of the products manufactured. If you would like more information about any of this, please follow the link on the next page.